Support for Short Stops is presented by the Caylum Trading Institute. Check out our website at www.cayluminstitute.com. On today's episode,
of the money I've allocated to equities, is there some amount there where I want to take additional risk, right, and potentially get additional reward? And that's where traders come in, right? And so the trader says, I'm willing to take on additional risk. I'm willing to make this my profession even. But in so doing, that has to be with the money after they've already allocated their assets, as any investor, right? In fact, when you see traders get into trouble, it's when they haven't allocated their money properly that way, and they start having to trade to pay the rent. A bad trader is someone who needs the money that month.
Yes.
A great trader can sit and wait and be patient.
call it what you want, a game, an experiment, a gamble. But stock trading in the global financial markets to us is a business. Every day you're surrounded by the noise. Buy, sell, hold, buy more. And we're going to quiet it down and filter out the best trading strategies, tips, and stock picks. You want information on how to find your next bagger or home run? You'll find it right here on Short Stops.
Ladies and gentlemen, welcome to episode number 32. Last week, we talked about understanding macro and understanding the sentiment. And today, we have a very, very rare guest that we'll talk about now on a global standpoint, and especially on the U.S. economy. With us today is President, CEO, and Chief Investment Strategist of Valens Research, Mr. Joel Litman. Joel, welcome to the show.
Thank you for having me. Great to be here.
To those who don't know, my first job was under you. It's been a long time since, it's almost 8 years ago, I believe. And it's fantastic for you to be here, Joel.
Thanks.
So maybe you want to introduce yourself to the audience and share how did you get started in the equities, in the equity market, and in the finance field?
I started out in accounting in '91, and the reason I went into accounting was because it's a recession-proof field, and that was one of the smaller recessions, but still a market pullback and whatever during the early '90s. And I thought that was a good idea. And I didn't realize at the time how valuable accounting was to investments. I'd say there is a lack of really solid, deep financial statement analysis in the investing field quite often. And we found that having that expertise has really helped us in understanding how to better invest. So the accounting parlayed into financial consulting, and the financial consulting ended up in banking. And then 10 years ago, we launched what is now Valens Research. Mm-hmm. And our job is to consult some of the world's biggest hedge funds, institutional investors. I think right now we have maybe 250 of the largest institutional investors in the world read our work every month. And that's partly because of the depth of financial statement analysis and I'll say even due diligence that we do.
So much has changed over the last 30 years. I mean, 1991, and I'm sure accounting principles, standards have also found ways to develop. But of course, there's still that level of inefficiency. That's why you're here, trying to help and clean all these financial statements.
Right.
In your experience, has the regulatory body done enough work over the last few decades trying to make those changes?
Oh, so speaking specifically to the accounting, no, it's gotten worse.
Really?
Yeah, of course. Yeah, the FASB and the IASB have created a mess of new standards. It's a misconception to believe that IFRS is a standard. It's not. It's a set of judgments and rules, which means you have even more elections, even more judgments, and it actually adds to the risk. Mm-hmm. If you look across all the great investors of the last, I'll say 30 or 40 years, none of them follow net earnings. Every single one, you will find a very public statement. Warren Buffett, in his first quarter review with Charlie Munger last year, in their 4 or 5 hour interview, right, the shareholder review, in the first 5 minutes he said, don't look at net earnings, it doesn't represent what's happening in my company. And then he went and adjusted it, and he showed line by line, here's what is going on in my divisions, and they were all up, but somehow the net earnings number, because of some funky accounting, was showing that they had a $5 billion drop from income the year prior. Now the stock didn't fall, the stock didn't crater, so clearly investors by and large, and the best investors in the world always adjust the financials when they're looking at companies to invest in. They always adjust. When you asked, what's changed, what hasn't changed since the market recession, the collapses in the early 90s and the early 2000s and 2008 is the pattern of credit and the credit cycle and how it impacts the equity cycle. That has remained consistent, I would say, for the last 200 years. What we find also is that people don't focus on credit as much. It's sort of like equity investors ignore credit completely because there is a decoupling. They seem to not matter in the middle of a bull, and then when it matters, people start catching up and saying, oh my God, I better start studying credit again.
Exactly, because the credit cycle is always the forward-looking part of corporates in general. I mean, the access to credit. So if you don't understand the credit cycle, meaning a lot of these businesses are all also on the business aspect, everybody's focused on the credit. And as an equity investor, if you don't look at how these corporates also look, you'll have that mismatch and always be late to the game.
Yeah, it's funny. Credit is naturally risk averse because they don't get the upside of the profits of the company.
Yeah,
right?
exactly.
They're limited, but they get just as much downside almost, right? I mean, they can still go to zero. So what you find is that credit leads going into a market collapse, but is always behind coming out of it. And so when we're where we are right now, and we're saying we're looking for, could there be a market collapse in the U.S.? Yeah, of course there will be. But it's not for another year or two. Maybe it's not for another 3 or 4 years.
Yeah.
Credit is so incredibly healthy in the States right now that you don't see the credit breakdown that you saw in 2007 that led to 2008's collapse. We do not see the credit breakdown that people don't realize happened in 99. Massive credit breakdown in 99. People often think it was just a tech bubble that caused it to burst. But no, there actually was a massive credit crisis that it just didn't receive the same headlines because the dot-coms were receiving everything. And so that was 99. If I actually could go back to 1929 or 1906, you'll see the same kind of credit crises always ahead of a market collapse. And we don't see that right now, which is why I joke around and I say the U.S. still has as much as 50% upside in the S&P from what we're looking at right now in January.
Going a little back, we're mostly talking about trading. So what's your thoughts on equity investing and trading? And maybe you can share, for example, what's your time horizon? Usually, what type of risk reward are you looking for in general?
The first job of every investor, bar none, is asset allocation, right? Is that the first thing they have to do is say, if I'm going to spend the money, whatever amount of money you have, if it's going to be spent in the next 1 to 2 years, it has to be in money markets or cash-like accounts, period. There's no way that the volatility in a 2-year period is acceptable if you know you're going to spend the money. There's too much chance. Bonds are down 2 out of 3, are down 1 out of 3 years. Equities are down 1 out of 3 years. And so if you're going to have 2 years of money put aside, you have to make sure it's safe. And so you want capital preservation. If you're going to go out 2 to 5 years, bonds seem to make the most sense. Over any 2 to 5 year period, bonds pay well, and if there is a down year for bonds, you have enough time to recapture it. Equities, as long as you're talking 7 to 10 years plus, equities is where you put your money. So that basis has to be the first step, a foundation of every investor. Then they can say, now that I've allocated my money correctly, of the money I've allocated to equities, is there some amount there where I want to take additional risk, right? And potentially get additional reward. And that's where traders come in, right? And so the trader says, I'm willing to take on additional risk. I'm willing to make this my profession even. But in so doing, that has to be with the money after they've already allocated their assets, as any investor, right? In fact, when you see traders get into trouble, it's when they haven't allocated their money properly that way, and they start having to trade to pay their rent. A bad trader is someone who needs the money that month.
Yes.
A great trader can sit and wait and be patient, as you know so well, as you know better than I do, right, in terms of your work. But I think people forget that asset allocation has to come first, and then you bring in the additional risk reward opportunities.
I mean, I think you speak on behalf of everybody. And I think the biggest challenge is that when you're starting out for a lot of people and then they don't have that investment capital yet. So to them, they just want to go all in. They just want to put all their resources into, for example, like the equity market, as opposed to like your level or somebody who's very seasoned in this field, right? To us, like we understand how important asset allocation is, but to majority might not be there yet. So I think everybody has to have that level of understanding that when you're building your wealth over time, you should also have this type of standpoint where
Yes.
you need to understand asset allocation.
Yes.
Yeah. I spent almost a year with you 8 years ago, and I still remember how your investment philosophy back then was always looking and trying to answer these three questions. And the first one is always about what's the market pricing in, where is the mispricing, and what is the catalyst that eventually people will see what you are seeing. Do you still hold this investment philosophy true up until today?
Yeah, because it's not my philosophy. That's the philosophy of the great 40, 50 investors of the last 100 years. So when you read the notes and the work of Ben Graham or Seth Klarman or Buffett or the entire Ben Graham class of the 1950s, 60s, so Walter Schloss and Ruane and Sandy Gottsman, meaning all these billionaires. I mean, people forget, Ben Graham didn't have one great student. He had like 10, 20 billionaire students, and they all follow the same philosophy. And so I would say that's the same philosophy we would follow, right? So it's not mine by any means. I've borrowed it and maybe translated it a bit, but the idea that when you're looking for an individual stock to buy, you first have to understand what's buried in the price, meaning it's not what you think that's important, it's knowing what the market thinks. Because you're betting against the market, right? If you're going to buy a stock, you're saying, I'm smarter than the market. The collective wisdom of crowds has not realized that I think this stock has a lot more opportunity than everyone else thinks. All right, so you're already betting against that wisdom. And then second, you have to believe that the market's going to agree with you. Because if you're right and the market never agrees with you, you still lose money.
And that's the
right?
difficult question for
Yes.
a lot of investors, right? How do you make the market realize what you're seeing?
Yeah, it's funny. You read these great investors, and that's where there may be some difference in how they behave, but they all understand the importance of the catalyst. So Buffett will say, I don't need the catalyst. If you look at his trading in his first decades of investment, his holding period was still something like 36 months. That's a long time to investors today, right? You imagine holding for 3 years, average holding time on an individual name, and that's how he did so well. He said, I have patience, so I don't need the catalyst. Whereas other investors who've done very well and have a much shorter term horizon have to have that catalyst. So if you need to show performance in a quarter, you'd better have that catalyst that says the market's going to agree with you in that quarter. Otherwise, you better be patient and wait 3 to 5 years, right? And that comes down to whether your philosophy as a trader or investor is, I need to see this work, well, then you need that catalyst. If you can wait and wait and wait, and you know it's a great idea, then you can wait 3 to 5 years.
I mean, with these three questions, can you walk us through like how Valens does it today?
Yeah, it's because we have such scale now, our scale, our coverage, back when you were with us, we didn't have such coverage, right? I mean, maybe we covered 1,000 companies, and we only covered what clients were interested in. Whereas now we cover and update, around 10,000 companies.
Wow.
Updated every week. That exceeds any investment brokerage, right? In terms of sell-side analyst coverage, no one covers that amount of names, including in Asia and the U.S. and globally. So we start by running embed expectations on every one of those companies, meaning in an automated fashion, we say, what is the forecast the market is building in a DCF model? What is the forecast the market's building in to every one of these stocks? And 9 out of 10 times, not even 9 out of 10, I'd say 49 out of 50 times, you say, here's what the market's pricing in. You look at that forecast and you go, probably right. And you move on. And you look at the next one, you say, probably right. It's very similar to poker. It's funny how many great investors say that poker and investing are so similar. How many hands in poker do you actually play out? Out of 20 hands, you probably fold Annie Duke, one of the greatest poker players. I mean, she would say 19 out of 20 hands she folds, only one she plays. I'd say in stock market, it's similar, but maybe even a higher number. 49 out of 50, you pass, and you
That's
find
true.
that one where you say, okay, the market's forecasts seem really off, way too high or way too low at some level that has, maybe they've gotten overly emotional in either direction, which the market can tend to do. Maybe they're missing something analytically. They're using as reported earnings numbers and they haven't taken the time to rip through it. And if we see that, then we say, all right, now we found something that could be a mispricing. And if there's a mispricing, then we can say, let's spend a bit more time on it. But if we first don't see there's something that looks like a mispricing, and most of the time there isn't, maybe even it's 99 of 100 stocks, you'd say, nothing to do. Nothing to do. I wouldn't waste our time. It's that one where you go, okay, something's really egregiously messed up, mispriced, misunderstood, misvalued, right? That miss word. And then you say, okay, now let's put time in.
Okay. I agree totally. I mean, especially in the markets such as US, where it's very efficient market, as opposed to developing countries such as the Philippines. So I mean, what's your thoughts on looking for mispricing, for example, in emerging markets?
Yeah, I'd like in the Philippines, China, and a number of other emerging markets.
Exactly.
And you say, is China still emerging? Investing-wise, absolutely. In the United States, institutional investors hold, on average, 85% of the largest 2,000 companies. 85%. In China, it's opposite. It's dominated by retail. So when you look globally right now, China has all kinds of incredibly cheap, inexpensive stocks, but they looked that way a year ago.
They've been cheap for a long time.
And they looked that way over a year and a half ago. And then, if I go back several years, when China stock market had an average PE of 70 times, everything was crazy expensive. Well, that's what happens with retail investor-dominated stock markets, is the emotions get caught up, and they tend to take high-level stocks to much, much, much higher levels. And when things get pounded, they get much, much lower than they ever do. Now, fundamentally, over time, all investors globally still trend towards discounted cash flow models. They do. But that upward momentum or that downward draft can make it a lot longer. You have to sit there and hold. So there's a bunch of Chinese stocks I'm holding right now. I don't mark to market every month. I don't check out my portfolio. I'm holding because I think they're going to do really well over the next 4 or 5 years. And I have to have that kind of Buffett kind of philosophy with those, that they're going to do well even though they're so cheap. Because right now, if they're out of favor by retail investors, that's it. And there aren't the institutions to come in the strong hands to build it. I think you see the same thing in the Philippines. Sometimes there's an entire market, that the entire Philippines market can get priced up and get very, very expensive. And trading, I think a few years ago, 35 times or something earnings, right? That's on uniform earnings. Now it's trading at something like 20 times uniform earnings, and 20 times is actually globally around average, right?
So it's still pretty expensive.
Yeah, I know. I'd actually say it's funny. It's expensive, and this is a unique thing about emerging markets. It's expensive if you have a high capital gains tax regime. So in the United States, a 20 times multiple is expensive if we have a capital gains tax or income tax that's in the 40, 50, 60% range. But in the US right now, it's down at around 20, 25%. And because of it, you can sustain higher multiples. In other words, investors will pay more for a dollar of earnings when it's not taxed.
Yes.
Well, in the Philippines, the government is essentially subsidizing Philippine
0%,
stocks
yeah.
because it's just shy of zero, right, in terms of capital gains. And so a 20 times multiple is reasonable.
Okay.
I wouldn't say it's super cheap,
okay,
but I would say it still leaves a lot more upside than downside.
Got it.
And I think that's especially with the demographics and the GDP growth rates and the health of the Philippine economy longer term, despite the, I'll say, headwinds that you see in emerging markets.
I mean, there's a lot of misconception when people talk about market timing. Everybody assumes it's all about charts, it's all about technical analysis. But when you're understanding market timing, and like what you just pointed out, I mean, you try to time it in a way that you're looking for something that's already irrational, or very cheap levels already. That's how you time it on your end, right? Because you see how like emotions of people are just paying ridiculous cheap prices for some of these equities that you're buying, like the ones that you mentioned in China. What do you think is your biggest competitive advantage?
First, let me address the irrational part. So you find prices that are irrationally priced low. And then two quotes come to mind that are like 50 to 100 years old. One of them is, the graveyards of Wall Street are filled with people who are right too early.
Okay.
Right. The graveyards of Wall Street are filled with people who are right too early. The second one is the market, from Schilling, the market can stay irrational longer than we can stay solvent.
Yes.
Right? And so that goes back to the importance of the catalyst. I don't know that if Valen's research is providing a competitive advantage to our clients, our investor clients, it's less so on the catalyst, and it's more so on the embedded expectations and potential for mispricing. And the reason is that to understand what the market's pricing into a company, you have to understand what the true earnings of the company actually are. And if you're using as reported GAAP earnings, the earnings that are reported on Bloomberg and FactSet and the newspapers every day and by the sell-side analysts, you are severely disadvantaged. There's no great investment house on the planet that doesn't adjust those numbers. And our clients are the shops that are big, but not big enough to hire their own 200-300 people to do it themselves. And so we've created a uniform accounting system that allows our clients who may be running a lot of money, but not enough that they can afford to build their own in-house, 200-300, 10,000 company a week restatement group to provide better numbers. And if you have better numbers, you can do better embedded expectations, which means you can better find mispricings. And I'd say that's the competitive advantage that we have amongst, frankly, other data vendors and other research providers. And I think that's why we're so widely read now.
Fantastic. What's your top investment themes for 2019 or in the next few years?
No, I like the S&P. I like the S&P 500. I think the U.S. economy is strong. It's been surprising people how strong it is. Unemployment is low, in great part because of how strong the economy is. With the correction that we've had, it has been one of the best buying opportunities we could have had. The correction, whenever you see a correction, you have to ask yourself, is this the beginning of a market collapse? Right? Nobody can top tick the market. Nobody can figure out the top. But once you've seen the market fall 10%, you can do the analysis to say, is it going to be another 30 or 40%?
Yes. If there's systemic risk.
Yes. Or is it going to bounce? In November, we were, fervent about saying, no, this is a correction and it's a buying opportunity. In December, we repeated that. It was a tough December when the market falls that much, but we repeated it and everywhere we could with our reports. And come January now, we're seeing the rebound that we had expected. And the reason being, when you see a sentiment-driven correction, but U.S. corporate profitability is at the highest levels we've ever measured, when U.S. multiples are at, I'd say, averagey levels. I have to say averagey because it depends on the day, but the levels that the U.S. market's at are on average. Credit formation is incredibly strong. Banks are still lending. Refinancing is at the strongest we've seen it. Credit default swaps, the cost of debt is one of the lowest levels we've seen, almost as low as going back to like 2004, 2005. You add all these things up, this is a very, very strong market that had a very, very negative sentiment. Negative sentiment is a positive for value investors. You want the market to be negative because that's when you get your buying opportunities. And that's what we just saw in December, and we still have now. So if there's a big call we have, I'd say intrinsically the S&P is cheap by maybe 15 to 20+%. But by the time it hits that place, the momentum investors are going to kick in. People are going to find that the U.S. is one of the best places to invest, and it'll send the U.S. market into expensive territory. And that's why I joke around that the U.S. I joke around, but it's. I don't think the U.S. intrinsically has 50% upside. I think momentum is going to give it 50% upside before it all comes collapsing down again sometime 1.5 to 4 years from now, and we won't know until then. Yeah. But it isn't now. Yeah. It isn't this year.
Okay. What's your thoughts on global growth slowing down? And there's always worries about China, obviously. That's why we're seeing commodities come down so much. We saw the 10-year treasury rates in the U.S. start to go down also from 3.3 down to 2.8, 2.7, I believe. Right? And these are all forward-looking indicators about what's happening in the next year. And obviously, like what you said, interest rates are still record low, credit's still cheap. So there's no reason for like any warning signs so far. Going forward, are these your concerns in the next 1.5 to 4 years? Is that the reason why you have that a little bit hesitation?
The hesitation comes from the amount of credit that's outstanding. And if you look at, not everyone looks at this part of the financial statements, but deep in the notes of the financials, every company is required to show their debt service for the next 7 years. So we look at that for the top 3,000 companies in the U.S., and we look at the debt service, and we see when it's due. And a lot of it is stacking up in 2020. 2020, even 2020. So right now, internally, we have a debate: is it 2020 or 2021 that we see, an issue? Because when everyone goes to refinance at the same time, everyone has this demand for credit, and the supply, no matter how good it is, can't make up for it. Then you've got problems. But you don't see that in 2019, which is why we have such comfort that it's not going to be this year. But it might be a year and a half from now, or it might be 3 years if they refi it down the road far enough.
And then the next question is, what's going to be the borrowing cost at that level, right? You're going to refinance at 2020, but if it's still cheap, would it still be a concern for you?
Well, it's one of these things. In 2009, the rates were cheap already, right, or getting cheap, but the money just wasn't available.
Exactly.
Because the supply was so far under the demand. And that's the case when everyone refis at the same time. So if everyone's refining at the same time, you may still have a situation where rates are mid-level,
Okay.
but it's just not available, right? Banks can only lend so much, and investment firms only have so much appetite for credit, regardless of the rate. And if they start worrying about defaults, they get concerned. So I think the credit default swap markets and the senior loan surveys, across the big commercial banks, will do what they've done in the past, and it'll give us the canary in the coal mine of when that next, whenever that correction is, faced with massive credit seizure. That's not just a correction. That's when the bear market comes in. All right.
This is a lot to digest for somebody who's starting out in their career or starting out investing. What would be your best advice to a newbie or a beginner?
The first strategy for an investor, even if it's you're trying to teach your kids to invest, is to find a monthly amount that they can commit to. Maybe it's $500 a month. Maybe it's less. Maybe it's $200 a month. Right? Some monthly amount that they commit to, and put that into an index fund, low expense ratio, that allows them to accumulate over time and get the benefit of the stock market. The United States, Schwab is one of the more popular accounts, and they have an ETF called SCHB, which is basically a market-wide diversified fund. It only charges 3 basis points of expense ratio, and you also get charged no commission buying or selling inside the Schwab account. It's a fantastic deal. In the Philippines, they're similar, right? XPEIF by PhilEquity is a nice broad market fund. They charge 1%, which is very low for the Philippines. And through COL, you can put aside money that through the EIP, right, the Easy Investment Plan. And when I'm in the Philippines, that's the first thing I recommend to everyone, is that find an amount, that's how you start it, find an amount every month that you can commit to XPIF, which I think in COL you can do as little as you open an account for 5,000 pesos, but I think you can do as little as additional 1,000 every month, and you buy that fund and you let it accumulate. And 20 years from now, there's a rule of 1,000 that if the market does well over the next 20 years, whatever you put away monthly in 20 years, multiply by 1,000. So if you can put away 5,000 a month in 20 years, it could be as much as 5 million, and you don't even notice it, right? Suddenly, you're semi-rich. In the U.S., you may not have as strong a market, and so maybe it's 600 times what you put in. But that's still such big numbers, and it's so easy. And so you want to get your kids started doing that at a young age, just so they get used to that monthly investment, no matter what else is happening. And if you're 40 and you're saying, I'd still like to retire when I'm 60 or 65, or I'd like to have a nest egg, or I'd like to be able to take a nice vacation, same thing, right? That of everything you're doing, you just start putting money away on a monthly basis, without looking at the markets, without looking whether it's up or down, without deciding, what day. Just pick a day of the month, and maybe it's right after a paycheck. And every day that month, you put that into XPIF. Right now, that's one of the easiest ways to accumulate funds. Day trading is a profession, and so I just did a program yesterday for a university. And it was on fundamental investing. It was long-term investing, looking for mispricings or whatever. And I had a couple people come up to me and say, what if I want to be a day trader? And I said, I think day trading is a fantastic profession if you're good at it, like any other job. I said, if you're going to try to do this, One, if you're only going to trade the Philippines, which is an issue because you've only got 30 issues with any liquidity, 30 stocks that have any liquidity, and so you may have nothing to do every day of the week if you're only trading 30. So if you're able to trade the United States, fantastic, but that means you're going to be up from 9:30 p.m. till 4 a.m., right? So if that's your profession and you're good at it, I've seen people do really well in day trading, right? And day trading or short term, and even with decent dollar size, right? But they have to take it as a profession. That idea that you see sometimes in emerging markets, to include China, where you see people day trading on their phones on the subway during lunch, right, or during a break, heading between workplaces or whatever, there's no way that's sustainable. There's no way people make money going that route. I very specifically, by the way, Edmund, the students that came up to me yesterday and asked, I specifically said, if you're really interested in day trading, you should look into Caylum, you should look at enrolling, and at least find out whether or not it fits, right? And then make a decision whether or not you want to do it. But don't take your money and just jump on the market and start saying, I'm going to be a day trader. I mean,
I might tell them not to do it either.
It's true. It's true. I mean, it's like anything. If you're very good at it, you're going to make money, right? But are you going to just say, I want to be a good surgeon and not go to school, right? And not spend time in residency with
and
other
experience.
people, right? And that experience, and I say residency is an important part. So it's not like you can just take an online class and become a day trader. I think if you want to become a great day trader, you should get an office or get to a desk where you sit around a bunch of great day traders so you don't make the mistakes that they made when they were in their 20s or when they were still starting out or whatever else. So I think it's a fantastic profession if you have time to do it. I don't, because I don't have time, right? If I were able to stay up U.S. hours and focus on it, I think I could do well, but that's not really my profession. My profession is supporting fundamental investors with financial analysis that would be difficult for them to do themselves, and yet awfully necessary to the investment process. And that's not day trading by any means.
Do you have any personal philosophies in life?
If we talk about wealth, health is first, right? Health is wealth. So whatever you do, I mean, and you find some traders, if you love trading and you're into it, great. But if it causes so much tension in your life that you can't handle it, then you should go back to asset allocation and stop trading, right? If it's going to take away years off your life, it's not worth it, right? And I think so, yes, asset allocation is important, investing. But if there were a philosophy above that, it's as you're creating wealth, make sure health comes first and the monetary stuff comes second, no matter what, right? No matter
guys, there you have it. I think we'll end on that note. Thank you so much, Joel. That was beautiful advice. If you guys didn't know, Joel is also half Filipino.
Ang nanay ko Pilipina.
Thanks, Joel, for coming on the show.
Thank you, Edmund. It was great. Great to be here. Thank you.